Hi, everyone. My name is Lucas Caceres, and I'm a certified financial planner and owner of Level Up Financial Planning. Today, I wanted to share with you a couple of debt management strategies to help you knock out some of the debt that may be causing you some stress. And with that, we'll dive into the presentation. Here's a few disclosures that are just required for anyone that participates in the financial services industry to disclose. Give you a few seconds to read through that. All right, so today we're going to cover a few things around the debt management strategies. When finance companies are looking to offer you credit, what they're looking for, the different various types of debt that you can incur, a few consolidation strategies, refinance strategies, and payoff strategies. So talking specifically of what those financial companies will be looking for in order to lend to you. So income is going to be very important. They want to make sure that you're able to actually pay back any loans that you take out, any credit that you have in your name. Also, they'll take a look at credit score. So this is usually a tricky issue for people that are just starting out on building their credit. Maybe they graduated, have a great paying job. Even with a great paying job, it's tough to get credit started if you haven't had something in the past to start building up a credit score. And so I used to work at a credit union way back when, and I just remember a lot of people would graduate, they'd end up getting a nice paying salary as an engineer and want to get just a minimal credit card, like $500 credit card, and they were getting declined because they didn't have any credit history to speak of. So it's important that you have some type of credit score. Sometimes bad credit's almost better than having no credit at all. Another thing that they'll take a look at is going to be work history. So depending on the types of loans that you're going for, in particular, things like a mortgage, they're going to take a look at your work history. They want to see that you've been earning income for quite a while. If your income's a significant part of your income is from bonuses or commissions, sometimes they'll discount that income just because it may be irregular and it can't be counted on every single year. So just be aware of that if you're going to apply for a mortgage loan. Another important aspect that they'll take a look at is going to be any outstanding debt that you have. So if you had a lot of debt, then that's going to give those creditors just a little bit of concern over whether or not that you're taking on too much than you can handle. So that's going to be something that they'll take a look at, and a lot of times they'll take a look at ratios. One of them is called debt to income ratio, and so that looks at outstanding debt, and then loan to value. So loan to value is going to be most important if you're going to be taking out a loan that's a collateralized loan. That would be auto loans typically, as well as mortgages. When it comes to purchasing a home, most creditors want to see that you're not going to exceed 28% of your gross income specific for that home. So it includes the insurance that you'd have to take out, any property taxes, as well as the mortgage. Another thing that they'll take a look at, again, at that outstanding debt, they want to make sure that that does not exceed 40% of your income. So there's a few different types of debt, and we'll take a look at them. There's unsecured and secured. On the unsecured side, there's things like credit cards, personal loans, store credit cards, any type of store credit, and payday loans. Those things are not typically going to be tied to an asset, and because of that, there's a higher risk to the lender that you may not pay them back. And that's why all of those types of loans and debt have a significantly higher interest rate. Sometimes it's 10, 20 times that of what you would be able to receive on an auto loan or a mortgage loan. Taking a look at those secured loans, those specifically have assets held as collateral and will have those lower interest rates. So I already mentioned that auto loans and mortgages will have a significantly lower interest rate because there's assets that can be repossessed if for any reason you fall behind on payments or unable to satisfy your loan obligations on that. RV loans are another form of collateral debt. And I threw student loans on the secured portion. There's not actually collateral tied to them, but student loans are very hard to discharge. One of the only ways that it can be discharged is actually through death. So even if you were going through a bankruptcy or something along those lines, student loans typically will always be there when you come out of bankruptcy still. So you can also look at debt a few different ways as well. So there's good debt and bad debt. And so if you've maybe you've heard your parents talk about this or a coworker, there's good debt, and typically what would fall under good debt would be something that allows you to purchase an asset. So there's different types of assets that you can purchase. There's appreciating assets. Typically, home value and real estate tends to go up more than it tends to go down. And so a mortgage for a home would be not only a good debt, but a good debt because you're buying an appreciating asset. But you can also have relatively good debt by purchasing a vehicle that you need in order to get to and from work, as well as if you have a family to kind of truck family around. So that's important. Most people in the world that we live in nowadays need some type of transportation. So purchasing a vehicle of some kind would be a valuable debt to take on if you had no other way of purchasing a vehicle. But vehicles do depreciate. They depreciate as soon as you drive them off the lot. So that's something to keep in mind. Because once you purchase a vehicle, it's not likely that you'll be able to sell it for the same value that you purchased it for, let alone if you're carrying a loan on it. Sometimes it's even hard to get back what you owe on it because it may depreciate faster than you're paying off the loan. And then I add an additional line. I've never heard it classified this way, but this is how I tend to think of it, but potential assets. So student loans for education, and education in and of itself doesn't necessarily mean that it's going to be an asset for you. It's kind of how you make your education work for you that makes it a potential asset for you to use in your future career. Bad debt is just something that allows you to purchase things that are not totally valuable to where they can consistently provide value throughout the rest of your life, and usually not necessities. So credit cards, those things that you typically purchase on credit cards, it's hard to remember what you actually purchased, why you ended up making those decisions. Personal loans, or sometimes loans that you take out in case of emergencies, and home equity loans, most of the time could be considered bad debt, just because when you're taking those out, you might be doing it to go on a family vacation or to help pay off the credit cards or personal loans that you've racked up that have had higher interest rates. Home equity loans do have favorable interest rates though, because it's still going to be tied to the home value, which could be repossessed. So lower interest rates there, but typically when people take out home equity loans, it's not usually going to valuable purchases. So there's a wide range of options that you can use to try to knock out some of your debt that you've accumulated. So there's consolidation. You can refinance your debt. You can pay off the debt and just kind of hit it how it stands, not try to maneuver around it too much, just pay it off as quickly as possible. You can possibly do some negotiated reductions to what you owe. I'd say be careful with those. I'm not too familiar with them, but I do know that there are a lot of bad companies and few credible ones. So just make sure you do your research if that's a road that you have to take. And then there's also bankruptcy, which would be kind of break in case of emergency type strategy. Regardless of which option you choose, you should always be looking to find ways to save and use savings towards paying off debt. So if you've kind of found yourself in a situation where things have been stressful, one of the best things that you could ever do is go and build a budget. And you should be able to find a video online. I just recorded one a couple weeks ago that you should be able to find where you're able to build out a budget and find different opportunities to save. By having additional funds to apply towards your debt, that will substantially increase your success rates of paying it down a lot faster than you would have if you were just making the same payments every single month. Let's first take a look at some refinance strategies. This could be an option that's on the table for you if there are lower interest rates available than what you currently have for whatever it is that you owe debt on. So one of the things that comes to mind is mortgages you may be able to refinance and get a lower rate. Vehicle loans you can refinance. A lot of people aren't aware of that, but if you find a lower auto loan rate, you may be able to refinance towards that. You may even also be able to do it for student loans. Student loans are a lot trickier. There's a lot of nuances as to when and why you may want to do that. So I'm not going to be able to dive into that today, but just be aware that that may be an option for those as well. And even with credit cards, you can typically find a better credit card rate. Sometimes you can find a 0% special financing for a certain period of time. Sometimes it's 6 months, sometimes it's for a year. Key with that is to not just be constantly going through a cycle of rolling those over. At some point, you'll want to start making progress to pay those off. Another thing that people sometimes are not aware of, and I use this quite a bit when I used to work back at the credit union, is cash out options that pay off higher interest debt. So I mentioned that you can actually refinance vehicles. You can refinance vehicle loans and actually get cash out. So if your vehicle is worth substantially more than what you owe on it, you may be able to actually take the equity of that vehicle, roll that into another auto loan, but then have that cash available to apply towards credit cards and other high interest debt that you may have accumulated. Another strategy for refinancing would be maybe just possibly extending out the term on lower interest debt to free up cash flow for larger interest rates. So this would be something where maybe you owed $4,000 on a vehicle loan still, and that's going to be paid off in 3 years, but you could refinance that vehicle, have it paid off in 6 years, reduce that monthly payment by about half, and that reduction of half of the payment that you'd have to make on that lower interest auto loan, you may be able to start applying that towards a credit card balance and pay off that higher interest debt a lot faster, saving you a lot in the long term. So even though it feels like you're doing some interesting strategies there. So there's a few payoff strategies just when you look at things straight up how they stand now. And my recommended strategy is going to be the debt snowball. And how that debt snowball works is you're actually going to focus on paying off the lowest balance first, regardless of their interest rate. And the reason why that's my recommended strategy is because there's been a lot of research and studies that show that that's actually more successful because you start to feel the progress of paying down your debt faster than if you do the debt avalanche, which is another payoff strategy. With the debt avalanche, you're paying off the higher interest first. That strategy actually has a higher savings amount when you apply that method, and you'll actually pay off your debt faster as well. One of the problems with that is typically the higher interest rate debt takes the longest to pay down. And so it may feel like you're fighting an uphill battle as you're trying to knock out that first 1 to 2 lines of debt that you have. And so a lot of people give up before they have that first success. And that's why I recommend the debt snowball. Regardless of which method you choose, just make sure that you're always making the minimum payments, and just any excess payments, any excess funds that you have to apply towards payments, that's how you're attacking those lowest balance first or the highest interest first debts, whichever strategy you choose here. And I'll go into that a little bit more how those work. So looking at the debt snowball, we have a couple of line items here. So there's an auto loan, a personal loan, and a credit card. And I'll just kind of let you read through those and how those appear right now. They're arranged in various methods. They each have their own interest rates, their own balances, and monthly payments associated with them. And in this scenario, this couple ended up doing their budget. They found that they have $200 extra a month that can be applied towards debt. So with the debt snowball method, they're going to look first at the smallest balance, which is the auto loan. Typically, that's just a $200 a month payment, but with that $200 extra that they found from doing their budget, they're able to apply $400 a month, and they're going to pay that auto loan off in 13 months. And so once that auto loan is paid off, they've already been making the minimum payments on the personal loan and credit card, but that next kind of line item there would be the personal loan with a $7,000 balance. That would be a little bit lower after that 13 months since they're still making the payments on it. And what would happen there is typically it would have been a $300 a month payment for that personal loan. Now you have that whole $400 that you were paying towards the auto loan. That's going to be a $700 a month payment, and that will be paid off within 18 months. Then the last thing to knock out would be the credit card, and kind of see how that debt snowball works, where those monthly amounts start to build up a lot faster, and you start to make huge progress towards each one of those debts as you focus on them. I'm not going to go through the mechanics of the debt avalanche. They work pretty similarly, other than you're just going to attack the higher interest first, which would be the credit card in this scenario. If you went through that same scenario with an additional $200 a month through the savings and the budget, you'll actually pay off the debt faster, as well as save $1,084 using the debt avalanche approach. So with that information, choose which one works best for you. But just be aware that the debt avalanche takes a little while to get going. And so it may feel like you're fighting an uphill battle with that one, although it's typically would save you the most money in the long run. So we'll talk about bankruptcy a little bit. There's two most common that individuals and families will use, even though there's actually 5 total types of bankruptcy. Chapter 7, that's going to be complete bankruptcy. Sometimes people call it fresh start bankruptcy. I would hesitate to say that, just because there's still credit checks involved with a lot of future borrowing needs that you may have. So let's say that you were going to go purchase a home or apply for a job even. All those things show up on your credit reports when they get pulled. And so it's not a fresh start if it's saying, hey, this person had a bankruptcy, but it does help give you a clean slate as far as getting rid of monthly payments and those types of issues there, and allows people to get it back on their feet. So it's definitely a significant option for those that need to take it. But I'd hesitate in calling it a complete fresh start, just because of those issues that come up with credit checks down the line. For Chapter 13, this is going to be more of an adjustment type bankruptcy, where it's going to be for individuals that still have a reasonable chance of being able to pay off their debts, and they also had the desire to try to pay off those debts. It's also going to help the borrower keep valuable assets such as home or vehicles. And typically why you would choose Chapter 13 over Chapter 7 would be if you have debts that are typically non-dischargeable. So student loans would be one of them, but there's definitely a few other that are tricky to shake regardless of bankruptcy. And so you may want to choose Chapter 13. One thing I want to leave you with is I love doing these educational webinars, because I'm able to reach a wider audience and give free information and valuable resources to people. If you feel that you still have issues or questions that aren't totally answered, and I'm definitely available on an hourly basis, kind of see my rates there. Another thing I enjoy doing is coming up with your direct kind of debt management strategy. So I'd sit down with you, find out what your overall objectives are. And what we'll do is do a net worth calculation, kind of see where you stand. And we'll build a step-by-step recommendation, giving you the exact details of whether you want to go with the avalanche plan or the debt snowball. And we'll kind of target when we're going to pay off each of those debts that you are currently trying to knock out. Are you on track planning? That's going to be more retirement planning, college planning for children, things of that nature. As you can imagine, complexity varies pretty significantly depending on what your goals and objectives are, and family size and things of that nature. So the price would vary on that, but I always offer a complimentary kind of consultation, see what it is that you're trying to achieve, and make sure that I would be the one to be able to help you achieve those goals. So feel free to reach out. There's still a few upcoming events I want to make sure that I get recorded here for everyone, and that'd be the Market Forecast 2018. It's already starting to become an interesting start to the new year, so definitely want to make sure that's available for you soon. Student loan repayment, that's quite a wide range of topic to cover, but I'm going to try building something that would get the general idea of what your options are as a student loan borrower. And Social Security rules, those are constantly changing, crucial part of retirement planning, and I'll make sure that I get that as well in the coming months. Again, I want to thank you for taking the time. I imagine that this isn't something that you enjoy following or having to listen to, but I imagine that you also have some goals that you want to make sure you achieve. I want to thank you for taking the time to go through this webinar with me, and feel free to reach out if you ever have questions. Feel free to share my information with anyone that you think would be valuable for. Thanks for being a part of this, and I look forward to hearing from you in the near future.